Good morning. This is Larry McMillan with a stock market update on Monday, July 11th, before the market opens. So I could pretty much play last week's recording over again. The market was up a little bit last week, but it was a very dull, holiday shortened week, and nothing really changed all that much. The S&P 500 chart is still in a downtrend. We have short-term support at the lows from 2 weeks ago at 37.30 or so, and then below that 36.40, which are the year-to-date lows. There's resistance above here. First, the gap at 40.17, and then the trading range from early June which begins at 40.70. So that's the near-term parameters. Longer term, if the market were to fall, make new lows, then we're looking at 3,500 and 3,200 as the support areas. Equity-only put-call ratios continue to drift sideways, which in our opinion means they are not on buy signals. They need to close below their June lows to move over to buy signals. So while they're high on their charts, meaning they're oversold, they're really not giving us any particularly strong bullish indication. Market breadth has improved, though, and the breadth oscillators are on buy signals at the current time, both New York Stock Exchange and stocks only. I wouldn't say they're wonderfully strong buy signals, but they are buy signals. So unless we have some very negative breadth in the first 2 days of this week, those buy signals should still be in place for a few days. Meanwhile, new highs versus new lows is just the opposite. We're still barely getting any new highs. I believe on Friday there were 7, and that's just not very many. So this indicator, new highs versus new lows, remains on a sell signal. The only thing that's kind of bullish is VIX. VIX is continuing to drop, and there are some conflicting ideas about why that's happening. But it means that the VIX spike peak buy signal that we've talked about before is still in place. And now the trend of VIX, which has been upwards and thus negative for stocks, is coming into question. The 200-day moving average is at 24, and VIX closed at 24.64 on Friday. So it's getting closer. VIX closes below the 200-day moving average. That will relieve some of the intermediate term pressure on the market. It won't change it to a buy signal, and the last couple of times this has happened, it's been short-lived. But in any case, that would be a somewhat positive development. Meanwhile, the construct of volatility derivatives remains about where it was. The term structure of the VIX futures slopes upwards out through October, which is just mildly bullish. So the only real change here is VIX. Is this representing some sort of summer doldrum where implied volatility is just falling, or is there some sort of a change really in the trend of VIX? I guess we'll find out in the next couple of weeks or so. Meanwhile, I invite you to visit our website, take a look at our newsletters where we cover these things daily, and have a great week trading.